it seemed like it was putting out one fire to another. We had a big crew, had a lot of jobs going. We made a lot of money, but I'll tell you, we lost a lot of money at the same time. It just didn't seem sustainable. I used to shop where nobody else was shopping. Nothing was for sale. The problem is now is that every building owner is looking at it. People realize we're at the top of the market. We can't really go much farther. So people are starting to think, if I'm going to cash out, now would be the time. I don't know when this is going to recover. So that has made our job a lot more challenging. We're having people come in and trying to sell us deals at 1, 2, 3 cap. And we're talking about D and C class assets that need intense rehab. And I explained to them, well, once we apply debt to this equation, we're finished. We'd be losing money. So how do I justify this?
This is Eric Odom of the Invest Florida Real Estate Show. For all of you Tampa folks, I just wanted to talk briefly about Suites at Madison. Suites at Madison is a place to conduct business, whether it is for an hour or a month. This is the place to get your work done. This is where we hold all of our networking meetings. This is where we host our podcast, but we're not the only ones who use the office. Title companies use the conference for closings. Real estate companies host their sales meetings here. Attorneys use the space for depositions. There was even a Canadian company recently who used one of the offices for a couple of months while they were setting up their permanent office in the Tampa area. So if you need a quiet place to get away for a few hours or weeks or months, or to meet a client privately, check out www.downtowntampaoffice.com to see what the deal is. Oh, and you can also sign up for our regular networking events there, so go check it out. Now, let's go on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, fall weather is upon us.
Fall weather is upon us, Eric. And, at this time in the market, it's still a very tight market. We still have low interest rates, and that implies risk because if interest rates increase, it's going to be hard for an investor to get their price back. So we have to look for ways, and investors have to look for ways to navigate the market and find ways to mitigate the risk and still be successful in real estate. And I think the show we'll have today will be on point because the person we're interviewing really has found ways, and he's spent a lot of time trying to figure this out.
You got all of that out of the fact that I noted that the temperature dropped about 10 degrees.
Well, it's kind of the temperature went down like cap rates went down, so I made the connection.
Okay. It definitely is that time in the market. You want to try to keep your head up and not just follow the path that everybody else is following, because you might find yourself on the wrong end of a deal. I'm in the middle of it's a pretty good transaction right now. Helping a client buy a piece of property up in Pasco County. It's a retail strip center. And I'm engaged in the due diligence with him right now on the property, and then we'll manage it. That's sort of our MO. Finding deals has been harder and harder. And this one, we feel like it's a pretty good deal, and working through the due diligence on that. But our guest is going to talk about some of the alternatives you might have and some other ways you might be able to do it. So we're looking forward to him talking. Before that, we're going to remind you guys, if you have not had a chance, if you enjoy this show, if you've not had a chance to give us a review, we'd really appreciate you going to Stitcher or iTunes or Google Play Store or whatever. Go to our Facebook page. I don't care. But give us a review. It helps us a lot, because when guests are considering how to invest their time, they want to make sure that they're investing it in a meaningful activity. And if you guys are leaving reviews, that's one of the first things they check to see, to make sure that there are listeners and there are people paying attention, because guests don't come on for kicks and giggles. Most of them want something out of it. They would like to be able to network with more people. They would like to be able to find deals. There could be any number of reasons, but everybody here is very busy, And for us to be able to convince folks to come on to the show, we need your help. So if you've not had a chance, we appreciate you going on and leaving a review at one of those locations. Stephen, anything else before we get rolling?
Excuse me.
What? That's a cold weather. It's stole your voice.
You choked me up with all that deep thought, but let's get rolling.
On to our guest.
Today we have with us Tyler Sheff. Tyler is the host of the podcast, The Cash Flow Guys. He is also a residential realtor with Future Home Realty. He specializes in income-producing properties, including notes and multifamily. He was born in New York, but now lives in Tarpon Springs, Florida. Tyler, welcome to the Invest Florida show.
Thank you so much for having me. I'm glad to be here.
Hey, Tyler, really excited about having you on the show. I know Steve and I are listeners of your podcast, a fellow Floridian doing a real estate podcast. Of course, you guys do something a lot different than we do. Why don't you talk a little bit about your show?
My podcast came from, I got out of real estate for a couple of years when the market crashed and all that. And when I went back into real estate, realizing I was looking for a tax break, I was out looking for opportunity, looking to learn the multifamily side of things. And I realized that you could really quickly spend more on real estate education than you do on the real estate. So I decided that as I was re-educating myself, that whole journey, I was going to document it in the form of a podcast so that other people could basically learn from my mistakes and I could maybe help more people get into real estate investing and get financially free. And that's where the show came about.
And so what are the topics that you typically discuss?
I tend to cover soup to nuts. We start with overcoming a lot of the limiting beliefs. You know, people are told, the gurus tell them to go start wholesaling houses and flipping contracts and doing things that are questionable activities and things like that. I educate them on practical, make sense things. It's real simple. House hacking. Maybe buy a duplex, move into one side, live in it for a year or so, and then move out and house hacking type of thing. So we like to take people that are both beginners and experienced investors and kind of give them a different outlook on the investing space, that it's really not as complicated as we'd like to make it seem.
And are you specializing in single family and multifamily?
I've gotten away from the single family space. Years ago, I used to flip houses way back in 19, I'm trying to think, I think year 2000, I was flipping single family houses in St. Petersburg. Made great money, but I also paid a fortune in taxes. Once I grasped the concept of capital gains, mainly by receiving the bill and then having to pay it, I discovered that when I got back in this time, I needed to mitigate my tax liabilities. The only way I could do that legally was to buy and hold real estate, whether it be commercial, residential, or whatever. I'm not a young man anymore. I'm 47 years old. I wanted to retire as quickly as I could.
You're half of Stephen's age.
I know, but still, you know. So for me, I had to eliminate my tax bill. I had to scale. I went to multifamily and I stuck with multifamily ever since. Multifamily and notes.
Now you've got an interesting background because so many people in real estate, they sort of either, come through finance or they're working in lending or something and then get into real estate that way. How did you get into the real estate game to begin with?
Originally, my mom has been a real estate broker for 40 years. So I was raised by a real estate broker. And so I was raised in the Century 21 gold coat days and the old weird looking bird on your desk when you got that. That's how I came up. I went and got my license way back in 2000 thinking that's what I wanted to do, but I realized I didn't really like being a realtor, a residential realtor. That wasn't what I was cut out to do. I wanted a bigger challenge. So I got into house flipping. And as I said earlier, though, that comes with a lot of pitfalls and an incredible tax bill.
Yeah. It's the risk situation where the government wants to share in your profits, but they don't want to share in the really much equally on the downside.
Exactly.
So you open up a wall, there's a whole bunch of water damage. They don't care about that.
No, they don't. Yeah. No, they don't. And they don't seem to really give you a whole lot of credit for those deductions.
Yeah.
But they're good at sending you the bills. They've got that down pat.
Yeah.
So, and it's funny how the cash disappears before the tax bill comes, and then you have to scramble.
You're absolutely right. It seemed like it was putting out one fire to another. We had a big crew, had a lot of jobs going. We made a lot of money, but I'll tell you, we lost a lot of money at the same time. It just didn't seem sustainable.
And when you originally got into it, you were doing something else. When you were in law enforcement?
I was military police, and then I also graduated the Tampa Police Department. I used to work for the local school board as a school resource officer at night. So I worked as a police officer here in Pinellas County, and of course did my time in the military as a police officer as well. So I loved being a police officer. I was good at it. I'll be honest with you. But when my daughter was born and I almost got killed one night on duty, I thought, this isn't worth it for $12 an hour. I don't want to be somebody's enemy for $12 an hour. So I quit and got into sales, and I've been in sales ever since.
Now, what year was that?
That would have been, my goodness, 1996, I believe it was. Yeah.
So was it immediately then you got into you started doing real estate?
No, I didn't get into real estate until about 99. I got licensed in 2000. I kind of got my feet wet a little bit.
The beginning of the boom.
Yeah, the beginning of the boom.
Huh.
And I rode that boom up. And in 2005 is when I sold all my inventory. I had a bunch of houses at the time. We had just got done flipping them, and I was greedy.
That was a smart move.
Yeah, well, it was only based out of greed. It wasn't out of intelligence, I assure you that. I didn't know the market was going to crash. I thought it was going to last forever. So I rented these properties out. I had about 10, 11 properties at the time. I rented them all out because I knew that back then my property value would jump 25% in 12 months. Simple math, right? Uh-huh. I did exactly that. I let them go up. I sold them all. I did my own taxes. I made a few mistakes, and I was billed accordingly for those mistakes.
So how were you positioned during the crash?
I was in great shape as far as I had cashed out prior to the crash. So I was sitting on a pile of money right up until the tax bill came. And that led me into a little bit of terror because I realized that my charm and attractive smile simply doesn't work with the IRS. Ugh. They want their money and they want it big. So I paid a 6-figure tax bill, which chunked into my profits. And back then I was a lot younger. So I did like to party like a rock star and did a little jet setting back and forth to Key West. And as I'm sure everybody knows, you can spend money pretty quickly down there and don't have a whole lot to show for it, unfortunately.
Yeah. A lot of those, when you're writing checks with a lot of zeros at the end, it's painful. And, I was reminded by my friends that, you're complaining about writing big checks. This is 2004, 2005, 2006. You complain constantly about it. I said, yeah, but when the inevitable downturn comes, they're still going to want their money. Like and it doesn't matter what's happening to me, how much money's going out the door. They still want theirs. And, it's hard for me to really save when you start moving into higher tax brackets. They're really taking a big whack out of you. And it makes it much more difficult to try to sock away when the times come. So, we've adjusted our business too.
Yeah. I've finally figured out that it comes down to how you earn your money.
Yeah.
Really dictates how you're taxed. And once I got a handle on that, then everything changed.
So when you came back in again to the real, tell us how you came back in again after your break. I went
and took a job working for the federal government. I was working on a ship as a bosun's mate. Basically, I was in charge of the guys that ran the cranes on the ship. I got promoted really fast in government because I found out that you don't really have to work that hard to be considered exceptional. Government employee. Can you believe that? But I got promoted really quick. So I started at $35,000 a year. And by the time I left, I was almost at $200,000 a year.
Oh my gosh.
With overtime and all this. So we're back to another huge tax bill. Well, this time realizing that my charm wasn't going to do it, I was Google searching how to legally reduce my taxes. And I kept coming back to one common denominator, and it was buy real estate and hang on to it.
Yeah.
Just hang on to it.
Yeah. Depreciation is a beautiful thing.
It absolutely is.
Yeah.
So I studied more about taxes and understanding tax code and found some great CPAs, but needed to get back into the game. And I really never knew how to hold property very well. I knew how to get a great deal on it and I knew how to fix it, but I really didn't grasp the whole management concept. So I had to learn that piece of it.
Now, you were doing some brokerage. You've determined that wasn't for you. And I know you've done some syndications. What types of syndications? How did you get your feet wet in that area?
I dove in. I cut my teeth in what I'll call the South Memphis shuffle, so to speak. Memphis, Tennessee is a great town for cash flow investing. It's not known for appreciation, but it's known for cash flow. I bought D-class multifamily housing. Basically had a mentor of mine tell me that I needed to get my feet wet. I needed to get some street credibility, some experience under my belt and really solve some incredible problems. So I kind of grit my teeth a little bit and I just jumped in and started doing it. And locally, I started doing some events locally to teach people what I had learned thus far. And by doing that and by pure networking, I found some folks that were willing to invest in real estate. They just lacked the knowledge to do so. I've always been good, Eric, at building teams. I've always been really good at that. So I was able to find a team of great people, and granted a lot of trial and error. I've kissed a lot of frogs in the process, but I got a good group, a core group of people, and I leveraged their experience, and that helped me big time as far as when it came to raising capital. I didn't have to rely on my own experience.
And did you prepare an offering memorandum and go the whole 9 yards, or was it an informal kind of?
The first deal was very informal. It was one investor. We gave them a promissory note and a mortgage against the first set of properties. And then from there, we hired we started talking to different attorneys and learning how to bring more than one investor together. So we've partnered with a couple of different attorneys that have helped us through the years in putting deals together, doing syndicates and things like that. The podcast has drawn a lot of attention actually. And I had a celebrity reach out to me and it was kind of interesting. We had to keep their identity concealed from the media and we had to do this super quiet deal, which was neat because I obviously got to ride on the front of that deal because they didn't want their name anywhere on it.
Right.
So that was a learning curve going through that piece of it. I'm a person of transparency. So that was, presented some challenges, but we got through it and, we made a lot of mistakes in the process. I'll be honest. We picked some of the wrong folks early on, learned our lesson from that, picked a couple of the bad contractors that didn't quite do things like they would and made some management mistakes. But the bottom line is I got an amazing education. I mean, I could have gone to college, I suppose, and learned that, but I don't think I would have got the same lesson. Making those mistakes and going through that pain, I think it made me a better investor. I'm confident that it made me a far better investor.
So you picked up some of your investors through doing educational pieces and some through your podcast. And you mentioned that you've made some mistakes with bad contractors. Have you made mistakes with bad investors? Because somebody getting in bed with somebody, lying with a dog with fleas. Have you had any issues with that?
I have, but fortunately we haven't gotten to the point to where we actually pulled the trigger with them. One of the things that I learned early on was to spend a lot of time with people up in the front in the beginning before you get started. Fortunately, I stuck to that advice and I kept on with it. But I did meet people that I thought initially were okay people as we get a little farther through the relationship. Because I'm not one that runs right to the altar, so to speak. You got to get to know us a little bit and we're going to really get to really understand each other, what makes us tick, why we're doing it. And I can't stress how important that is about raising capital is really understanding the why, both my why and their why. And I was able to discover that these folks were not the type of people that I really wanted to do business with. So we were able to gently back away from the situation, so to speak, and focus on other investors.
So from the time you started in syndication, did you learn along the way and maybe change the process? Is there a template that you use now?
I made a lot of mistakes. I asked a lot of questions, first of all. I teamed up with I went to the seminar in Dallas put on by the Real Estate Guys podcast, the Real Estate Guys Radio. Great group of people there. Sure. And I got to meet a lot of those people that are active syndicators doing it. And I was amazed how willing they were to help. There was no dumb question. These folks that I met at these seminars, and these are just other syndicators they were very willing to share. There was no scarcity mindset. It was very much, they were thinking in abundance. And that was a huge help because they became a resource for me. I could pick up the phone and ask the dumb question. And I wasn't the type of guy that was afraid to look stupid in the first place, which is probably a good thing because I did look really stupid and I still do look stupid.
A little humility helps to get some answer to questions.
Yes, it does. Yeah. So I leveraged that and I was fortunate to come up with a really good management team up in Tennessee. They had been in business since 1942 and having the ability they've watched lots of syndications go right and lots of syndications go wrong. They saw that I'm a straight shooter. I'm an honest guy. I take it very seriously when I'm playing around with somebody else's money. It's more important to me than my own. They respected that and they were able to kind of help me navigate through those shark infested waters because it can be kind of scary out there sometimes.
It's interesting. And getting back to your point on the investors. So many syndicators will get in and they might be talented real estate guys, talented numbers guys, talented construction guys, whatever they might be. And they'll go to whatever it might be, the RIAs or through podcast or whatever means they have of getting investors, obtaining investors and partnering with people. And they don't think about that aspect of it. And they get into these deals and then realize that even though you might be the managing member, you're still married to these folks. and they can be really crazy when there's money on the table. And so something you talked about that, hey, make sure you're of the why.
Absolutely.
Can you talk a little bit more about that why?
People tend to have misconceptions and they'll convince themselves of things that aren't even close to being accurate. For example, returns. They think that they have these. Sometimes I've had people come up to me and say, well, I know that I've seen these syndicates and I can get an X% return. And on the back end of the deal, I'm going to make a killing. And I have to remind them that we're not there yet. We haven't arrived at the back end. We can do pro forma, and we can forecast the future, but it's a forecast. It's not a guarantee. So we can't write checks off of that. There are pitfalls that can happen. There are things that can blindside you sometimes. And I have to continually remind investors, don't invest money that you're not willing to lose. That's very important as the qualification process. And
so that's one of the red flags. They start getting a little
Absolutely.
nervous about, so when am I going to get my money back? How is this going to work? That's a red flag,
Yep.
right? Okay.
We've had some younger investors, and nothing against the younger folks, but they're in more of a rush. They're not willing to wait things out. They want a quick return. And especially in notes, we'll tell them usually that it's 12 to 24 months before you see your first return. And 3 months in, we've had them we're not even to the point of placing funds yet, and they're already chomping at the bit. They're looking for the gold at the end of the rainbow. And that's not how things work.
When you go into the deal on the front end, do you do a projection of an anticipated return?
We do it depends on the deal, but most recently we've done a preferred return to investors. Then we'll do a pro forma as far as what we expect down the road. We'll do a 5 and a 10 year. I think it's important that, real estate travels in cycles, as you both well know,
Sure.
Being commercial agents. I like to project through what most people would think are cycles. 5 year, you might find yourself smack dab in the middle of a cycle. 10 year, you should have a different picture. So I think that if you use any type of forecasting model and you use 2 data points down the road, 2 date points down the road, I think you're going to be a little safer. I am very conservative as an investor from the get-go. You say 10% management, I say 15, because I know the phone rings in the middle of the night. I know that management companies have to be changed sometimes mid-contract. These things cost money. We allow for that, but that makes us work harder in the deal acquisition phase. In other words, underwriting for us is we underwrite a lot more deals than probably your average syndicator would.
And when you typically are underwriting, you talking about the numbers and do you have a team that's helping you with that underwriting? And tell us how that works.
We do. And one of the biggest advantages I found early on, I learned from a mentor, was to hire a fractional CFO. I didn't know such a thing existed, but a fractional CFO, for those that don't know, is a chief financial officer that works on contract, so to speak, or works part-time. A CFO worth their salt is a 6-figure position. Starting out, that's difficult to stomach that kind of paycheck.
Or with one deal.
Right. With one deal, the deal can't afford it. So you don't have one. Now you're guessing. When we're guessing, I think it was, I don't remember who it was, said investing is only risky when you don't know what you're investing in. Berkshire Hathaway talks about that a lot, but what we found. Warren Buffett. Yeah. And his company. I think that's on the front of the building at Berkshire Hathaway when you walk in. But we found using a fractional CFO to really deep dive those numbers.
How'd you find this guy?
Believe it or not, LinkedIn. Talking to a lot of people. You go on LinkedIn, you typed in part-time CFO or fractional CFO, you'll start to get some examples.
That Buffalo guy we talked about before?
Right.
He's a fractional CFO.
Oh,
based over in St. Pete.
Okay.
Worked with, he's taken companies public, and he's worked with Checkers, and worked with, oh my gosh, I forgot some of the other public firms that he's worked for, but now that's what he does. I mean,
LinkedIn can be so powerful. I mean, there was just something in the paper today about a company in the Midwest, in Montana, that got a huge contract in Puerto Rico because he went on LinkedIn.
On LinkedIn, yeah. I dismissed it early on, but I do find that as a great search engine. And I met my current CFO that way. He's been really, really good to us.
Real estate based? Was he have real estate experience?
He hadn't, but he's very, very good at managing companies.
Yeah.
He gets the in and the out and the whole 9 yards. I'm a good negotiator and I'm good at managing people, but I am not by any means a numbers person. I can do a pro forma, no problem, but I still need someone to check my math. Not the highest and best use of my time.
Right.
So having Michael in the picture, I know that I have him to rely on. I can call him into a boardroom. I can call him into a situation, and he can be the smart guy when it comes to that stuff, because that's not where I belong. I'm the guy out sourcing opportunity and making deals and making things happen.
So you've got the CFO, you've got the attorney. Who else is on your team that you're building?
We got a series of bankers, depending on where we're doing deals. It seems like the money picture, the financial institutional lending is constantly changing.
Yeah.
You call one week and the underwriting criteria is this, and then 6 weeks later, it's a completely different underwriting criteria.
Well, that's why it's important to have a few different lenders.
Yeah, absolutely.
Are you dealing with agency debt, or is it local bank debt? Or?
Local bank debt primarily, and then we've focused primarily on just raising our own capital. It's getting to the point. It's been a challenge. I'll be honest with you recently, getting capital from the banks, getting them to look at deals. Had one recently that drove by a property. Now, full disclosure, we buy value add properties.
Sure.
We intentionally buy them ugly. We get that. We get them with bad, terrible books and whatnot. That's how we find our value. But this guy actually left the office after talking to him. He drove to buy the property and said, "We will never loan money on that property." I said, "Why?" He says, "Well, those people have a couch in the parking lot." I said, "That's one of the things that we're going to change." He says, "Absolutely not. I won't even look at the deal." He hadn't seen numbers, hadn't seen anything. I was flabbergasted.
Man, these guys, man,
And
you're
this
buying
was
at the top
locally.
of the market. That's already, you're pricing it for perfection. To miss that, to be so short sighted to see, well, if I make this improvement, the property is worth so much more. It's just, I guess that's why they're bankers and not investors.
I even countered. I said, "I'm writing this at a debt coverage ratio of 2.0.
Oh my gosh.
I mean, you can't get much more conservative than that. Am I
Yeah.
correct? I know that traditional guidelines are between 1.25 and 1.65 right now in this market. Debt coverage ratio. I'm writing it far more conservative than that. Wouldn't even talk about it. So because of that, we've started to kind of shy away from the institutional lenders. And of course, doing notes, I really get a behind the scenes look at the institutional lenders, and not real happy with what I see in that regard.
So bankers, attorney, CFO, is there any construction people on your team?
We do hire construction people, but I'll be honest with you, construction people from year to year change. It's amazing to me how large companies can open and close pretty quickly. We've had one good contractor up in Tennessee, which is why our emphasis is on acquiring property up there. Florida is a lot more transient when it comes to contractors. So we've had some challenges finding contractors that stay in business long enough to ride it out. I'm leery to get involved in some larger projects here in this market because of the contractor piece. That's a problem.
What about the management of the properties?
Management is outsourced on every property. I have had challenges on management, but now I'm locked in tight with good, solid management. I've had them working with me now for several years. We've worked through some pretty amazing challenges, both locally and up in Tennessee, especially up in Tennessee. And I'm completely confident with their skills. They're big management firms with good leadership and good people out in the street. I pay them well, and I expect good results. And I think that's part of it. That's a big piece of it.
I'm going to shift gears without a clutch here, but I just remembered, it just dawned on me that you guys have a mutual friend.
We do. Who's that? Chris?
Chris Kremitzos.
Chris
Absolutely.
Kremitzos. I
Yeah.
just in Dallas with Chris.
You're in Dallas with Chris?
Yeah.
Yeah, Chris is, he's probably the reason we're
all sitting here
Yeah,
because
yeah,
Chris
absolutely.
really was he helped really fuel this whole podcast phenomena that's taking place.
He absolutely did. And that's why he was in Dallas. He's the reason why I launched the Cash Flow Guys podcast. I wasn't going to do it. I was going to go on a cruise with the real estate guys instead. And he says, "I think you should cancel. I think you should come with us to Podfest." And that's what changed it for me.
it's, I had been talking about because I'm a huge podcast fan. I mean, I listen to hundreds of hours a year of podcasts, driving to and from work, looking at properties, or listening to podcasts. And I've been telling Stephen about, listen to this podcast and listen to that podcast. We might consider being podcasts. I'm trying to give you a little bit of an insight into our Stephen and my relationship. It was probably after about 6 months to a year of me telling him this. He comes in like all exasperated after a lunch meeting. He goes, "Man, there's this thing called podcast. And my friend Chris Kamitsa says this is great and we should start one." And I was just like, okay. But that's sort of an insight in our,
Yeah.
but Chris is a man who influenced him, not me.
He amazing guy. I mean, amazing guy. And he's probably one of the largest proponents of podcasting out there, and for good reason.
Getting back on the subject a little bit, you were doing multifamily. Like, could you tell us a little bit about the size deal, and then we'll move into what you're doing next?
We generally keep our deals small. We like to stay under 100 units if we can. What I found is that obviously in the the 2 to 10 unit space, you find residential realtors usually have these things listed. Pricing is a challenge. There's the egos and all the whatnot that goes on. So instead we focus on generally over 10 units, under 100 in that sweet spot. They're too small for most commercial brokers to bother with. It's not a big enough price point. So we're usually dealing owner direct. We're dealing with the mom and pop type of people. They're very unsophisticated. Usually the books are almost non-existent.
So you're going out and soliciting them yourself, doing mailers and
boots on the ground and whatnot,
Gotcha.
Especially up in Tennessee. We've got boots on the ground. We know when certain management companies will take over an asset, we know that we can set our watch to it. This about 6 to 8 months, we'll start knocking on their door because they're going to have some problems. It's a matter, they change management companies a lot up there in Tennessee. So that's one of our strategies to get great deals is we find that they're having management issues and that can pretty much bankrupt any investment.
Well, as the market's improved so much now and the cap rates have got so low, you must be struggling also like everybody else to find deals.
It's a challenge. I'll tell you, it is a real challenge because when I used to shop where nobody else was shopping, nothing was for sale. The problem is now is that every building owner is looking at it. People realize we're at the top of the market.
Sure.
We can't really go much farther. So people are starting to think if I'm going to cash out, now would be the time. I don't know when this is going to recover. So that has made our job a lot more challenging. We're having people come in and trying to sell us deals at 1, 2, 3 cap. And we're talking about
cap?
Yeah.
Wow.
D and C class assets that need intense rehab. And I explained to them, well, once we apply debt to this equation, we're finished. We would be losing money. So how do I justify this to?
And then they show you projections, right?
Absolutely.
They don't base it on actual.
Yeah. Pro forma says that you can get $750 a month for these apartments. Yeah, but they're actually renting for $300. So I don't think it's possible to do that much rehab. Will you relocate this to a different part of town?
So what kinds of things are you working on now?
Yeah, so you're struggling to find multifamily deals.
Yeah, multifamily.
You're still doing them, but you're struggling.
We are. It's far and few between, I got to say. Yeah. We haven't done anything in quite a while. It's been almost a year now before we've done one. We did one little small fourplex over in Tampa, but outside of that was outside of our buying range.
Sure.
It just fell in our lap, so I said I might as well grab it, But primarily now we're working on non-performing notes, and this started with one of my partners, Paige Panzarello. She has been in the note business for a couple of years before I was. I was resistant to it. I fear what I don't understand, like most people. I didn't understand how notes worked. And how she finally captured my attention. She says, Tyler, if you're having a hard time finding apartment buildings, what if you own the debt instead of the building? I said, oh, now you have my attention. How does that work? And she explained that we can, instead of buying the asset itself, we can buy the debt at a discount. Well, we're negotiating with the owner of the debt, not the owner of the property. If they now obviously in a non-performing situation, now it kind of puts us in the driver's seat, gives us a lot more control. And as I learned more about notes and I saw the profit margins in notes, I thought, well, this is really interesting. And the rest is history. We've been doing it ever since.
It's actually a good strategy when you're at the peak of the market.
Absolutely.
And have you been able to use the notes in order to foreclose and get control of a property?
We have.
Actually, is that the strategy?
That is the strategy.
Okay.
That's one of the strategies. So every situation is different, and we do have very strict laws to work within. So this takes a much larger team than it ever does for just taking on an asset as itself, because now you've got a team of attorneys and debt collectors and all these different people involved to make sure nobody is taken advantage of and whatnot. But the premises here is we go in and buy the mortgage. We buy the debt, the note from the property. The borrower has stopped paying at some point, and the bank now wants to get rid of the toxic asset. They want to move the asset. They want to cash out, take their losses, and move on. So for simple terms, we're going to use $100,000 if we can, $100,000 face value note. We'll go in and buy this directly from the asset managers for about 30 cents on the dollar, let's say. So we're spending about $30,000 coming in. We're going to spend between $5,000 to $7,000.
Just to stop you there, that deal that you're buying for 30 cents on the dollar,
right?
How delinquent is that deal at the point you're buying it?
It varies. Usually you can count on at least 6 months or greater.
They haven't paid in 6 months.
At least.
Okay.
The next step probably is foreclosure. The banks do work pretty hard to try to get them to reperform, because of the value difference. A reperformance, if the note is reperformed, it'll sell for 70% of value versus 30. So they do a valiant effort. But again, we're dealing with large quantities in a lot of cases. So they'll dump a lot of the bigger banks, Wells Fargo, things like that. They'll dump large tapes of toxic assets. We'll buy up these assets, pennies on the dollar. At this point, once we do our due diligence, which is lengthy, you think due diligence is a lot on a commercial property, try a note. Think about everything you go through when you go to get financing for a property. It's extensive. We have to go through every piece of that paper. That is going to determine how successful we're going to be on the back end, whether or not we're going to be able to foreclose. That's where we analyze our risk. The asset is one piece of it. Granted, it could be trashed. We'll send people out for that, but the proof is in the due diligence. It really comes down to the packet that we're sent over. And sometimes, gentlemen, that'll be thousands of pages of paper that comes over some of these files that we've seen.
And so what are some of the potholes that you run into?
The lender's not doing the paperwork initially properly. They'll make mistakes when they grant the mortgage or they grant the loan, and that puts us in a position to make it challenging to be able to successfully foreclose.
Have you run into situations where you cannot foreclose?
We have run into situations in due diligence. We did not buy the notes, fortunately. The beauty is they have to show their cards before we'll buy. So we make an offer on a note. They accept the offer. Similar to buying a house, they send over a due diligence file. We have a period of time, usually a week or two, to go through the due diligence on the file. But we found these things in due diligence where they violated the owner's rights.
Attorney going through that, or you're the one going through those?
We initially go through it, and because we can weed out a lot of things on the surface. And once we go through it and give it a sign off, then it goes to a legal team. Make sure the T's are crossed, I's are dotted.
Okay.
You would be surprised how many due diligence files out there are essentially fraudulent mortgages. They're not able to be successfully foreclosed on.
And how would that be fraudulent?
Names are wrong. People haven't signed things. There's blank documents. There's things where copies were on top of other copies. In other words, somebody superimposed the signature on where things weren't. A lot of the stuff from the mortgage crisis, when you look at the notes that were originated back in the early 2000s, those are heavily scrutinized. As a matter of fact, we tend to avoid anything written between 2002 all the way up to 2010. We avoid those notes because they're just wrought with fraud.
All multifamily or single family too?
Both single and multifamily. In the single family space, for those notes, they must be owner occupied notes. We don't do any investor notes on the single family side.
And how do you actually go about finding the notes?
My partner, Paige, is very, very good at building relationships with the banks. She spent several years. She was a contractor for many years, very high end. She built high rise buildings and whatnot. So she had a lot of big contacts, important contacts in the banking system that have kind of opened doors for her, got us into asset managers so that we can get our hands on the tape right away. We, from day one, committed when we decided to do this that we were always going to follow through. We're always going to close. We are the type of people that our relationship is most important, our integrity. We have never not closed on a note when we said we were going to close on a note. That gives us a lot of buying power in the marketplace. They know that no matter what, we're not going to flake out on them. And, the asset managers have a lot of pressure on them to perform.
And is there a lot of competition in finding the notes? Acquiring them?
There is. However, one thing banks do a really bad job of is marketing their own notes.
They're terrible.
They're terrible at marketing their assets.
Horrible.
Yeah. I can tell you.
They won't return your phone calls. They have no systems of of trying to get the information out there. And as well as I do, the bigger the market is, the more competitive the price is. If they're not returning people's phone calls, they're not making accessible to the public, then they're getting a better price. Is that accurate?
Absolutely. They react when they get pushed against the wall. They'll ignore the situation until it festers to the point to where they've got to act. And usually that's what Paige does. She'll fly around the country, start to realize that some of these people that are impossible to get a hold of are the ones holding the gold. Because like you said, they're terrible at follow-up. Good, because eventually that guy's probably going to get fired or get himself in trouble to where he's got to move assets quickly. I mean, I'd like to believe that it's like we see on TV and they're all fancy and everybody's squared away and that little screen's going and everything's perfect, but it's an absolute train wreck.
And the decisions they make. I mean, when Stephen and I got involved with, and I'm not going to name the bank, but one of the larger banks, she ended up was handling all of her assets here in the Tampa area with a residential broker who was a friend. What a train wreck that person was. And at that point, there's really very little you could say to them because everything was going to go through this person that knew absolutely nothing about commercial real estate. And by the way, she had a handful of people 3 or 4 people or 5 people that she had on the commercial side that she was basically doing some unethical things too to make sure that those deals always went through her people. Amazing.
I'm not surprised.
Yeah.
I'm not surprised.
Yeah. So she's flying around and she's relationship with the banks. Are there conferences and things that she's going to?
There are note buying and selling conferences. It's a constant, ever evolving process of getting out, shaking hands, kissing babies type of thing.
And do the bank guys attend those conferences?
They absolutely do. You know, the bank guys, they got to remember they have expense accounts. They're paid to travel. That's part of what they do, a lot of these guys. So they take advantage of it to the nth degree. Forging those relationships, if you're willing to invest the time, is not rocket science. You just have to be more persistent than everybody else is really what it comes down to.
So these deals, I mean, obviously if you find a handful of them, you're going to blow out of your equity pretty quickly. So how are you finding your equity to make these deals work for you?
We're raising capital. We're doing these as joint ventures, primarily as joint ventures. We're looking at, we're to the point now, we're actually talking about this last night. We're going to go ahead and open up a fund, do a PPM and open up a fund because we're looking at, we have some opportunities coming that are going to require a lot of capital in a rather short time frame. So based on that, we're going to go ahead and do a PPM, do a filing and get that squared away. Prior to that, we've been using joint venture, a lot of independent folks, both accredited, non-accredited, that are looking to keep their money moving, keep it going, get into something that's not as volatile as what the house flipping type thing. A lot of people, that's the only option they have is to invest with some house flipper that may or may not get it right. There's no systems in place to protect them, to give them an opportunity to choose, does the deal make sense or not? The beauty of what we do is that this is an active investment for them, for the people that we partner with. In order to stay compliant with SEC regulations, they can't be a passive investor. So we give them a decision-making position in the deal so they can look at the note, look at the due diligence, talk to the legal team, gauge the risk and decide if they want to go through. And if they do, they fund the deal and then we share in the profits. We do the work, handle the workout, and then we share in the profits.
And how much of a deal do you typically keep when you go into a joint venture?
Generally, the investor brings 100% of the capital. And in a situation like that, when they're bringing 100% of the capital in, we will do all of the work. How the splits go is the investor's capital is returned first. So they get 100% of their capital back. And then of the proceeds, we'll split that 60-40, 60% on our side and then 40% on the investor side. That can equate to pretty healthy returns.
Yeah, I mean, you're putting in all the sweat equity and getting it right, and it takes a certain expertise. And can you speak to the types of returns that you've been seeing lately?
Our average right now is hovering. I'm glad you asked that today instead of yesterday because I probably would have had to look for the answer. But last night we actually talked about that. We're averaging 44% right now across the board. We've got about 100 notes that we own right now, and we're averaging a 44% net return on our notes.
So the structure of the deal is not inside of the Reg D private placement. It's a joint venture.
It's a joint
because
venture.
Because they are involved in the active management decision making process. It's
absolutely
not okay. So that's a bypassing. And so in terms of you have a cookie cutter management agreement, I suppose, on these joint ventures that with each one of your investors. How many different investors do you have? At
the moment, I'd say we got between 30 and 35. It varies. We haven't had anybody pull out, but we got several people that are coming in. What people find usually is once they get in, they tend to stay in. Actually, I take that back. Last year, we had one person pull out because they moved offshore and they wanted to move their money elsewhere, move it overseas. So otherwise, everybody that's come in has stayed in.
IRA folks, a lot of IRA folks or no?
It's a delicate mix. It's about 40% private money and 60% IRA. So it is weighted towards the IRAs.
So can you just touch base how people do that with their IRAs?
Two different structures. So some of the IRA administrators don't like joint venture operations. They're just, whatever reason, it's a challenge for them for compliance reasons. In that case, we'll give them a preferred return. We'll structure it as a note. I shouldn't say preferred return. We'll structure that as a promissory note, using the note as collateral.
Sure.
So that way it keeps us in line with Reg D and the SEC regulations. So there's option A, which is the most profitable for them, is a profit share, like we talked about, a 60-40 split, joint venture operation. There are some, like I said, IRA administrators that won't allow that. In that case, we'll structure it as a simple promissory note and a mortgage.
Now, you talked about pooling these because you've been doing them one off and you're going to start pooling them. So what kind of structure are you going to put your fund in? How is that going to work?
To be announced. We're bouncing back and forth between two attorneys firms trying to decide who we're going to give the business to. This is a little different than the real estate piece. It's a kind of a new path that we're charting. So in this case, we're interviewing two of our law firms that we've used in multifamily and trying to decide which probably making a decision here in the next month or so, which way we're going to go with that. And that will dictate the structure.
Can you talk a little bit about like the ideas you're batting around and some of the pros and cons of each one in terms of the structure? Like, was it 506 or, Reg D, or is it public? Obviously not going to be a public raise, but.
Well, I'll tell you, one of our biggest challenges is that we really want to get to the point we want to advertise. Because there's a lot of good returns here, good solid returns. We've been doing it now for several years. We're confident in it. We've made mistakes, but we've learned from them and we feel really good about what we're doing. We'd like to be able to advertise this and to do a full PPM, keep it to accredited investors. But then again, I got to be honest with you. This may sound corny or cliche, but I like knowing that we can help the regular person. It's great working with accredited investors. It's easy. They're sophisticated. They know what they're doing. It becomes a very plastic transaction. But that also, although it's profitable, there's no emotion to it. It's just that. It can get a little boring. We like to be able to take the middle of the road person that, hey, we can supercharge your retirement plan and then maybe help them raise the capital to still invest in real estate. Cause I still believe very much so in the power of brick and mortar real estate. I mean, notes create a taxable situation. Call it like you see it. It creates a taxable event where real estate can help mitigate that.
And have you ever looked at crowdfunding as?
I have briefly. I didn't get too much into it. What I find is that when you deal with a large number of unsophisticated folks, it tends to draw some challenges, I would say. I looked into it enough to think, wow, I'm going to deal with a whole bunch of people that don't have really much money to lose, because let's be real. When we're talking about investing, as I said earlier, don't put yourself in a position to invest money you can't afford to lose. And I'm afraid that in these crowdfunding situations, when people are coming in with small amounts of money, some of that may be because fear of risk, but I believe a great number of that is people are playing with money they can't afford to lose. I don't want to be part of that.
Yeah, I completely understand.
And you've also got all the reporting systems that have to go with it.
Absolutely. It's very, very cumbersome. And I'm working on a 5-year plan. So
if an investor would want to get into it, I mean, obviously one of the methods they could get into is to call you. Mm-hmm. And that would be one method of if they want to try to do it to start themselves, and maybe they own some houses and whatnot, and they say, I think the notes are a good idea. Is there one show? Is there a conference or something that can maybe get started to get connected with some of these lenders that might sell notes to them?
There's lots of free education out there. Eddie Speed is pretty much nationwide known. He's kind of like the note education guru. He's got some free stuff out there. You can get a good understanding of what's going on. Let's be honest, though, the win or lose in the note buying business comes down to the due diligence. That's really where it lies. If the due diligence is careless, you're going to lose money. There's no doubt about it. I guarantee you're going to lose money in the note business. So when it comes down to that piece, I would spend a lot of time self-educating, truly understand how notes work and what you should be looking for before you invest with anybody. Gotcha. I think that's critical.
That's great advice. And if folks do want to talk to you further about these opportunities, Tyler, how would they reach you?
Best way to get us is through our website, cashflowguys.com. I've actually done 4 episodes on notes in my podcast. Feel free to take a listen to those episodes. We talk about the good, the bad, the indifferent, and the things you should watch out for. And no matter who you invest with, please take the time to educate yourself and be thorough in who you're working with.
Awesome.
Yeah,
Stephen?
It's interesting to go in a different direction. It's real estate, but it's a whole, you're making your money buying. You just have to manage it so that you get your returns.
Absolutely.
And do you ever find individuals that are selling notes, or is it usually going through banks?
We do, but we found that the record keeping is not to our standard with the individual notes. And I know a lot of that goes on in the RIA meetings in the local investor market, and that's all fine and dandy. But for us, we take it very seriously when we're dealing with somebody else's money. That's utmost importance to us, that we take every step to make sure that they're protected. It's been my experience that when looking at the due diligence files from the mom and pop note shops, it's not complete, or it's not to standard, what I feel would be to standard, so to speak. So we tend to shy away from those.
Awesome. Tyler, any other great words of wisdom before we let you go today?
I'd say get started. If you're somebody that's on the fence about investing period, get started. There's too many people that are waiting and wanting to learn, and they're going to go spend a lot of money on education. Education's great, but you got to get started somewhere, and there's no better time than today.
That's awesome. Awesome news. One of my old bosses used to say, there's the people that do, and there's the people that get ready to get ready. Don't get ready to get ready.
That's right. Fire, ready, aim.
That's right. That's right. So, Tyler, we really appreciate you coming in, investing the time with us today. Love your show. Folks that haven't had a chance to catch it, you want to give the website so that they can look it up?
It's cashflowguys.com, cashflowguys.com.
Stephen?
And is there an email or anything if people need to reach you or have some questions?
Best way to get us is at info, I-N-F-O, at cashflowguys.com. That'll go to somebody on the team. If you got a specific question for me or you want to get on the phone and have a conversation about what we talked about today, by all means, just send me an email and let us know, and we'll get something scheduled for you.
Well, Tyler, real estate's always moving and going in a different direction. And it's nice to see you progressing along the path and taking different paths to maximize your gains. So kudos to you.
Thank you. I appreciate that.
Tyler, thanks so much, buddy.
Thank you.
And that was Tyler Sheff, podcast host, Cash Flow Guys, investor extraordinaire, real estate agent, a little bit of everything, Stephen. I'm so excited to have Tyler on the show. I've been a listener of his for, ever since he's been started. I love, he does a little bit different things than we do, but I definitely like and love his insight, his motivational approach to helping investors get into real estate. What were your thoughts, Stephen?
I love the direction he's taking with notes, because you can't find bargain properties in today's market. He's finding another route to do that, but it's a minefield too, because the due diligence is so tough and it's hard to find them. So he's figured out a system to do that.
Yeah, I mean, he's setting up the system really for the next downturn, when at the top of the market, if you want to try to skim some cash flow. Notes are a great way to do it, but it is, as Tyler said, it's fraught with risk, additional risk, legal risk in terms of the documentation. So you've got all the property related issues that you would have with any real estate purchase. Then you have this note and mortgage, and making sure that things are all the I's are dotted and the T's are crossed to make sure the deal gets done. Hopefully you guys got some out of that. If not, Tyler at his podcast, he talks about notes, and you can certainly visit him there. Stephen, anything else before we let our listeners go today?
Just want to remind you guys to download the apps, and you can listen to it while you're mobile, or just go to the investfloridashow.com.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Steven Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.